Please like, share, and subscribe.
Arise, you workers, from your slumber. All you wage slaves, everyone.
The revolution comes like thunder, and the age of hypocrisy is done.
In your papers, you make a distinction between two dynamics in the economy that you say is overlooked by mainstream economists, the distinction between the current production and consumption on the one hand, and finance, insurance, and real estate on the other. So for our viewers at home, can you explain this distinction? Why is it so important for understanding the economy we live in today? Dirk, do you want to start?
Classic, thank you. This is important because we live in what you might call the capital gains economy. So we think of capitalism as a system which is motivated by the pursuit of profit, but it might be more appropriate nowadays to characterize it as a system which is motivated by the pursuit of capital gains, also known as asset appreciation. The big gains and the way to get really rich is really to have assets and see them increase in value. And we will come to how that happens and what it needs in the system. And that this is not sort of innate, inherent in capitalism as such, but it's really a special feature of capitalism since about the 1980s. But it means that to understand how the system works, it's not enough, or even we better not try to understand how profit is formed, but we better understand how capital, how the values of assets such as bonds, stocks, and real estate are formed. And that is why we need to make a distinction between those two dynamics. On the one hand, the GDP, the gross domestic product, which is the sum of all incomes. Incomes are either wages or profits. And that is the focus of conventional economics, and properly so in industrial economies. But nowadays we live in financialized economies, including real estate financialized economies, where capital gains and the value of assets, including real estate assets, is really the important dynamic and certainly the way to understand inequality. Let me leave it at that for now.
Sure. Michael, do you want to add to that?
Yes, the real key is what is a product? We've spent much of the last few years trying to analyze the national income and product accounts and the GDP, and we realize that what is counted as a large part of GDP and national income and product is not a product at all. It's a transfer payment. For instance, when Dirk and I were in Washington putting our statistics together, I called the Commerce Department and said I was bewildered. Where are the late? I know that credit card companies make more money from late fees than they do in interest. Well, we could find interest payments in the NIPA accounts. I asked, where are the late fees? And the answer was, I could not have made this up, providing financial services. Well, the theory is that this is a service, and the underlying reaction a century ago against classical political economy and the whole value theory of rent and prices and value, and rent being the excess of market price over value, meant that this rent was unearned income, and it was deemed unearned because it was not involved in creating a product. When landlords raise the rent, they don't create a product, they charge more. When monopolies impose monopoly rent, that's not a product. And when banks charge interest and late fees and provide all of the other management operations they do, much of this is not creating a product. And so what we tried to say was, well, when you're comparing the product of the United States, European countries, and let's say China or other countries, and we adjust we divide the GDP into what's really a product and what's a transfer payment, we have an entire different picture of the economy. And the revolution, the anti-classical revolution a century ago basically said there's no such thing as economic rent. And Milton Friedman says there is no free lunch. Well, what we find is that the whole economy is about getting a free lunch, and that the not only is the financial sector playing a rising role in national income and GDP accounts, but its role is not to really increase production because it's overseen deindustrialization since the 1990s. Its role is to create wealth financially, mainly by debt leveraging. And if you can look at how 80% of bank lending in the United States, England, and other countries is for real estate. And the effect has been to increase the degree of debt leveraging for real estate, and that increases the prices. And what's many families during the run-up of housing prices in the early 2000s made more money on the increasing market price, I won't say value, but market price of their homes than they did earning a salary to actually produce goods and services. And so this is why we realized that the aim was to create capital gains. Well, how do you sustain this system? How do you stop it from collapsing like it did in 2008 and 9? Well, the only way to really keep it going, the Federal Reserve decided, was to follow the zero interest rate policy and just provide enough credit to enable economies to debtors, households, corporations that were taken over, and countries to keep paying their debts by you lend them the money to pay the interest. That's what Hyman Minsky called the Ponzi stage of the financial cycle. And we looked at the economy basically financially as a Ponzi scheme to keep the what seems to be the economy growing, but it's really keeping the debt overhead solvent. It's keeping the financial sector solvent. And all of this is counted as increasing GDP and national income when it's actually creating an economic polarization that concentrates income growth in the wealthiest 1 to 10% of the population. And they don't make money primarily by increasing production, but by transfer payments, by financial engine, by asset price inflation. And that's we've been trying to explain how do we use the statistics to siphon through, and we found a lot of problems with the statistics because they're made under certain economic assumptions, and the assumptions underlying the GDP and national NIPA accounts are not do not reflect how economies really work.
Dirk, do you have anything to add to that before we move on?
I think we've said quite a lot already. Just two numbers to sort of maybe drive home what we're talking about. In other work that I've been doing with Steve Roth, we've put together numbers that show the difference between saving and wealth. So the usual conception is that people get rich by saving. People get rich by making a lot of profit, having a nice company, be entrepreneurial, or work very hard, and anyway have high income and save a lot out of it, and that is how they accumulate wealth. But that's not how people get rich. People get rich by owning assets and see them increase in wealth. So what we did is we added up the savings in the United States, in aggregate, in total, since 1960 until 2024, the most recent. So the US statistics are fantastic. It's the only country in the world for which you can do this. And so in nominal dollars, not taking account of inflation, everything in nominal dollars, cumulative, so added up year by year, added up savings increased from 1960 until now from 0.3 trillion to $29 trillion. Okay, $29 trillion was saved. Now, what is the wealth that households in the United States have? It is 169 trillion. Okay, so it's impossible that they got so rich by saving, because their wealth is a multiple of all the savings in the country added up over all the decades since 1960. So this shows the end result of what I call the capital gains economy, and the end results of the dynamic that Michael just talked about.
Well, one of our charts showed that the capital gains in the economy is larger than the GDP. The annual capital gains is larger than the GDP, to give you a sense of proportion. And it's very funny, when you think of savings, think about what the Austrians said, that the financial sector and bankers provided creditors provided a service as part of the production economy. The service was not consuming by being abstinent. And that led Karl Marx to quip that the French bankers, the Rothschilds, must be the most abstinent family in Europe. Just to give you an idea of that. I mean, it's not really a financial service that makes these gains.